Welcome back. In this episode, I'm going to walk you through how I think about building a strong portfolio of stocks that will get you through any type of market and one that you'll be proud of years from now. We're going to talk about the different types of stock to invest in and when to buy each one. We'll talk about diversification and some data that helped me figure out the perfect number of stocks to put in my portfolio. Then we'll move on to when to buy and when to sell stocks and how long it can take to build a strong, well-rounded portfolio. And lastly, we'll take a look at some data around why I put in the time to pick individual stocks. Why is it worth it? But before we get started, keep in mind that this is not financial advice and should not be taken as such. Portfolio structure will differ between investors, and at the end of the day, this is personal finance. What works for me may not work for you. But if you do find value in this video, drop a like and subscribe if you're interested in learning more about stocks and investing. Okay, first things first. Dollar cost averaging and buying stocks every week or every month is the tried and tested way to win in this game. And that's essentially the overarching theme of how I build my portfolio. There are some small nuances to that we'll cover later in this video, but essentially I invest $500 every single week regardless of what the market is doing. And during dips, sometimes I come in and make outsized deposits. But the bottom line for me, being in a position where you have more income than expenses and only investing money that you don't need in the near future is the way to go. There will be bear markets and you may choose a stock that goes down 50% either permanently or for a period of time, and being able to hold and add to your portfolio at that time is the way to succeed in my opinion. For more information on that, watch this video next if you want to learn more about why you never sell out of the market and the cost of missing just the 10 best days over a 20-year period and how detrimental essentially that can be to your returns. I also talk about compound interest in that video. Lastly, in my opinion, I really don't think investors should be picking individual stocks unless they truly have the time and are willing to put in the work to stay up to date on their companies. If an investor isn't willing or can't put in the required time, I think ETFs are probably better suited for them. Okay, with that out of the way, let's move on to the second thing I want to cover, which is the different types of stocks. Stocks are often categorized into three main types: growth, value, and dividend stocks. A part of my diversification is owning all three types. The person who has pointed this out and preached the importance of owning all three types for I don't even know how long, and really who led me to implement this strategy into my own portfolio is Jeremy from Financial Education. He always talks about the GVD, growth value dividend strategy. Now, there is some overlap between these three types. Value stocks are often also dividend stocks, but not always. Growth stocks can sometimes be priced so cheaply that they really seem like value stocks. Still, I wouldn't call them value stocks because true value stocks are usually slower growing and offer stronger current earnings relative to their price. Growth stocks, on the other hand, typically have way higher valuations because investors are betting that their future earnings will be much bigger. That being said, when a growth stock gets cheap, I buy it for its growth potential, but also because it's offering great value at that point. And growth stocks will often turn into value stocks when they've reached their scale. And in rare cases, often when sentiment around a stock is negative, we can find stocks that have the characteristics of all three of these types. Okay, now let's focus in on each type of stock. Let me provide a better description and provide some examples. So with growth stocks, typically they have higher revenue growth rates that accelerate each quarter. And when investing in growth stocks, I think you want to get in at the start of the growth cycle. Stocks that continually increase their rate of growth, meaning their growth goes from, let's say, 12% in 1 year to 15%, and then 20, and then to 25, can reach ridiculous valuation, and that ride up can be very fun. However, you have to be aware of the dangers associated with buying growth stocks, because when their growth curve starts flattening or even declines, or in other words, decelerates, deceleration is probably the biggest killer of growth stocks. Once their growth rates start going from 25% in one quarter to 25% the next quarter, meaning it stagnates, then let's say it goes to 24%, then 22%, and it's starting to decelerate. The growth investors are typically very quick to dump that stock, especially if it's already reached a super high valuation. And those drops can honestly be vicious and in many cases unreasonable to the downside. Let's take Celsius as an example. If we look here at the revenue, as soon as their revenue kind of stagnated and even went down in 2024, growth investors absolutely dumped the stock. And you'll see from the peak down to the bottom, which is less than a year here, the stock fell more than 70%. So that's what I'm talking about when I say that it can be dangerous to invest in growth stocks if you're not getting in during the start of that growth cycle. And Celsius at the time was honestly trading at unreasonable valuations. If we look here at the price to earnings back in 24, it was essentially a price to earnings ratio of 100 plus. But investors were betting on those growth rates continuing and the future earnings potential of that company being much higher than it is today. In my opinion, Celsius was oversold. And the reason for those really high growth rates that they were seeing at the end of 2023 and the start of 2024 was because of their new distribution deal with Pepsi, who essentially overordered Celsius products and filled up their warehouses around the US. And then all of a sudden, one quarter, they kind of decided to cut down on their inventory, so they didn't order nearly as many Celsius products. And that's when Celsius's growth decelerated. But as the stock fell, I still believe that Celsius was a great company that was going to keep putting up good growth rates over the next few years, even though the previous ones had been a little over exaggerated. And that belief comes from the understanding that Celsius has done such a good job in marketing their products as a healthier option that fits into more of the lifestyle category and athletic category as well. And as you might have noticed, health, fitness, and just cold beverages are all categories that have been growing rapidly over the last couple of years. And they're pretty much the first energy drink company that has appealed to both males and females, which I see as a huge positive. But yeah, to summarize, growth stocks can be more dangerous and harder to time. I personally like to buy them when there's some sort of negativity that's overblown and before they start their next growth cycle. Now, to provide some examples, as I said, Celsius is an example of a growth stock. Just look at this accelerating revenue growth over the past couple of years. And with this accelerating revenue growth, Celsius was for a long time one of the best performing stocks in the market. Then we have Netflix, which also look at this, growth. In the past 10 years, they've grown revenue 20%, almost 21% every single year. And if we take a more recent example, Palantir, probably the most popular stock in 2024, if we look at their revenue again, incredible growth in the past 5 years, almost 30% growth year over year. And more recently, they've even been, making their way towards the 40% year over year growth. And with that, the price just kind of went crazy. The forward PE right now is 231, which is ridiculous. Uber is also a growth stock. If we look at their revenue here, past 5 years, 24%. However, unlike Palantir, Uber trades at a 29 forward PE. Obviously, recently they've had some, negativity and issues with Tesla's robotaxi and Waymo potentially disrupting their business model or whatever. But every other indicator here, trips, they're growing trips, 20% a year in the past 2 years. Gross bookings just keeps going up and up and up. So this is an example of a company that saw some, short-term negativity, and I got in. And lastly, Amazon is also, an example of a stock that has been growing incredibly fast for a very long time now. Past 10 years, 20% growth every single year. They have so many different businesses that are all growing. AWS being kind of the exciting part of the business right now. I think Amazon in the next decade or two is an example of one of those stocks that will transition from a growth stock to a value stock. Ultimately, their numbers are just going to get so big that their growth rates are just going to shrink. And, as the growth rates shrink, it's less appealing to growth investors. The valuation typically drops and value investors come in and kind of pick up those shares. And as that transition happens, it's probably natural that Amazon at some point will start paying a dividend, start buying back more shares to return value to shareholders in that way. Okay, moving on to value stocks. These are typically characterized as slower growing stocks. They might often be seen as more mature, and maybe the growth days are behind the company at that point. And now they're focused on profitability and returning value to shareholders through dividends and share buybacks and so on. These stocks are often seen as defensive, and they are often the big consumer stocks that essentially sell things that consumers will continue to need regardless of how the economy is doing. Healthcare stocks are also often seen as value kind of defensive stocks because people continue to be sick and require medical attention regardless of how the overall economy is doing. And there are a couple other industries that are usually grouped into these value defensive type stocks. And it's typically, the things that continue to run as normal regardless of how the economy is doing. But essentially, if I had to summarize it, these are stocks that will preserve your wealth better and are overall more predictable. To provide some examples of value stocks, I think PayPal right now has kind of shifted from a growth stock to a value stock. We've seen the revenue growth kind of slow down. You can see historically they had pretty good growth, 14%, but in the past couple of years, 4, 5, 6%. So this one's kind of a value stock at the moment. And with that, they, started returning value to shareholders through share buybacks, largely bringing down the overall shares outstanding. And they also trade at a very low valuation, just a 12 forward PE. Walmart is another company that is kind of seen as a value stock. If we look at the revenue growth, under 5%, nothing special. However, for some reason, Walmart is not really trading at a value stock valuation right now. I personally wouldn't touch Walmart right now, but the same thing. The growth slows down. They start paying dividends. They start buying back shares. They're paying $1.5 billion in dividends every single quarter. Procter and Gamble is another one. They own so many brands, from dental hygiene to toilet paper to hygiene, overall hygiene, health, and whatever. Again, their revenue is even negative in the past couple of years, but very slow. And these companies are typically at a point where they're hundreds of billions of dollars in market cap. And again, as I mentioned, a lot of these companies start returning value to shareholders in other ways like dividends and share buybacks. Johnson & Johnson is another one, low forward PE, again, revenue growth that's pretty slow, boring. United Health Group, low forward PE. They have slightly higher revenue, so they're kind of, I would still classify them as a value stock, but I mean, 8 to 10% revenue growth is still above the market average. So they're in this group of kind of being between a growth and a value stock, overall a pretty top quality company. Whirlpool is another one, extremely low valuation on this one. It's largely because their revenue has been going down a lot in the past couple of years. I think that's because the housing market has been pretty much frozen. But yeah, again, the growth days are kind of behind it. They return value to shareholders through dividends. They pay, wow, their dividend yield is all the way up to 9%, which is, yeah, that's massive. Okay, moving on to dividend stocks. This type of stock is way simpler to classify. It's essentially just a stock that pays a dividend. That being said, though, there are good dividend stocks to buy and bad ones. One of the biggest traps that new investors fall into is the dividend yield trap. They might see a super high dividend yield and get all excited about all the dividend money they're about to receive, but as they're receiving those checks, their wealth is being wiped out because the value of those shares they hold is dropping way more than the dividends that are being paid. And typically, there are reasons for stocks declining in value year after year. Something might be fundamentally wrong with the business. Maybe it's, shrinking revenues and margins, and sometimes it can be something else. And guess what happens when the revenues start to shrink and the margins start to shrink? The payout ratio, which indicates what percentage of a company's net income is distributed as dividends to shareholders, gets larger and larger, and ultimately the company has to either cut their dividends completely or partially. So after that, investors are left with shares worth half of what they paid for and no dividends. So that's why I don't prioritize the starting dividend yield, what the dividend yield says when you're looking at the financial metrics of a stock right now. Instead, I try to determine if that business and the business model is in a position to grow revenue and profit every single year, and what their dividend growth looks like. I would even go as far as saying that a high starting dividend yield, let's say 5% or higher, is probably a sign of a declining company. Unless you're looking at a REIT or a real estate investment trust. REITs are required by law to pay out at least 90% of their net income to shareholders. And real estate being naturally higher cash flow investments, you can expect a 5 or 6% starting dividend yield in a lot of cases. And lastly, on dividend stocks, it's important to realize that your dividend yield is not the same as the starting dividend yield. As an example, let's say you bought 1,000 shares of Coca-Cola 20 years ago. So 20 years ago, 2005, you would have been buying shares around $20 a share. The dividend yield at that time might only be, 2%, 2.5% or something like that. But as the company grew, obviously the share price increased. And if the company continually grew their dividend, your dividend yield might be closer to 10% today. Because if we do some quick math, you bought your shares for $20 a share. Currently, you're getting a dividend of 50 cents every single quarter, so $2 per year. So, $2 of that $20 per year is a 10% dividend yield, meaning every year you get 10% of your initial investment back in dividends. And if you wait another 20 years and the company continues to grow their dividend, maybe that's 25% of your initial investment you're getting back every year in dividends. So your dividend yield can be 10% or 25% and so on. But to provide a couple of examples of some dividend companies, Coca-Cola is one. As I said, think about the revenue growth over time, increased revenue. Same with earnings, increased earnings generally trending up to the right. And if we look at the dividends, they're growing their dividend, 4 to 5% every single year. Cheesecake Factory is another great dividend stock, in my opinion. Low valuation in this one. This is one that I've been buying recently. Their revenue generally trends up and to the right. And when I look out the next 10 years with Cheesecake Factory, they have these, next couple restaurant chains that they're launching, which, I've tried, I'm impressed with, and I think, will continue to grow around the US and around the world for the next decade. But yeah, EPS up and to the right, cash flow, it's a little bumpy for Cheesecake Factory, but up and to the right is what we want. Dividends, they had to cut their dividend during the COVID crash, but as they grow, I expect this dividend to expand rapidly. Pepsi is another famous dividend company, starting yield of 4% here. Revenues generally increasing year after year. Again, same with EPS and their dividend growth, they're growing their dividend 7, 8% every single year. That's what I look for. Visa, another great example. Low dividend yield here, but it's because Visa is a pretty sought after stock. It's highly valued. But, 10% revenue growth for a company that is 600 and something billion dollars in market cap is incredible. But the dividend growth here is 13, 14, 15% even. Costco is another one. Let's look at their dividends. 12, 13% dividend growth. Home Depot is another example. Let's look at their dividend. Rapid growth since about 2010, and the company has continued to grow revenues every single year, grow EPS, grow free cash flow so they can sustain that dividend, keep raising it. Okay, moving on to section 3 of this video. Building a strong and well-rounded portfolio takes time. Before we get into this section, I want to give some context around my portfolio. So let's have a look at my portfolio. If we take a look at the all-time performance, we're sitting at around 20% gains. At the peak, it currently says 32%, but this is one of my biggest criticisms for Robinhood. They don't offer, a time-weighted view of your portfolio. Since I've been adding so heavily to this portfolio recently, as we, dropped in the last couple months and my overall contributions have increased a lot, that peak in percentage terms just kind of keeps getting lower and lower. And at the peak, a couple months, I think I was sitting on 40% gains for the year. Anyway, back to the point. This specific portfolio is around 1.5 years old now. And I would say around half of these positions were started in the last 6 months. Essentially, I shifted my portfolio and moved into positions that I think have major upside potential for the next 3 to 4 years. And I did that around 6 months ago. So let's take a look at my individual holdings. And before I explain why it takes time to build out a strong and well rounded portfolio, here is how my current holdings split into those three types of stocks. So SoFi, growth stock, Shopify, growth, Celsius, growth, Cheesecake Factory, I see that as a growth value and dividend stock because, they're paying a dividend, their valuation is nice, but I think they have a lot of growth potential over the next couple years and the next couple decades, honestly. Uber, growth stock, PayPal, value stock, Amazon, growth, Robinhood, growth, GXO, growth. These are still very small positions. They're kind of just like watcher positions. Google, growth value and dividend stock. As I said, we can find instances of stocks falling into all three categories. Google has great growth, 11, 12%. Their valuation is so low, they fall into that value category. And they, as of recently, pay a dividend. ASML, growth stock, and they also pay a dividend. ELF, growth stock, AMD, growth stock. So currently, most of my holdings fall into the growth category. Now, I'm young and I'm willing to take that higher risk right now for potentially better returns. But as I age, that mix may shift towards more value and dividend stocks, or just as my growth stocks naturally become more like value stocks. But I think the mix of your holdings fully depends on what level of risk you're comfortable with. Okay, so as I mentioned, this portfolio is around 1.5 years old. What we're looking at here is what I call my top quality watch list. This watch list has the best of best quality companies in it, in my opinion. However, over the last year and a half, the valuations on these have been historically high. And I always want as much value for my money as I can get. And I wasn't quite ready to jump in on those at that point. I think the high valuations on these specific stocks was related to the worries throughout 2023 and 2024 that a recession was coming. So people preferred these rock solid, stable businesses to get through tough times. And that recession never came. But essentially, even though these stocks are my top quality stocks or whatever, I saw better potential for returns elsewhere at that time. And because there were a lot of worries about recessions, a lot of the growth stocks were trading at attractive valuations. And that's because, as we talked about earlier, growth stocks can swing wildly and unreasonably to the upside, but also the downside. So I would say this is another reason my portfolio is full of growth stocks right now. But over time, there will be better opportunities and better entry points to get into these stocks, in my opinion. But as an exercise, let's look at this chart to see if I was right or wrong about my calls back then. At the start of 2024 is when I was looking at a lot of these stocks and felt that they were kind of, overvalued. For a couple of them, I was clearly incredibly wrong. FICO and Booking holdings. FICO reached valuations. I mean, they were up like 100%. They doubled since I was looking at them. But I mean, FICO reached such ridiculous valuations that I would never have expected that. Looking back, Booking Holdings was probably undervalued. It would have been a good time to buy, but for the rest of them, MasterCard and Visa slightly outperformed, but the others underperformed. Now, as I said, most of my holdings are pretty recent, as in newer than 6 months old. But if I add the holdings that I was buying back at the start of 2024, PayPal, Amazon, Shopify, and SoFi, you can see that those mostly turned out to be decent buys. SoFi is high up on the list, Shopify is high up on the list, Amazon is high up on the list. PayPal down here in the orange is the only one out of those four that has underperformed the market. I was buying PayPal for valuation reasons at the time and built out my position to around $6,000, which was probably like 20% of my portfolio at that time. It ran all the way up to, right here, end of 24, start of 25 to around $90 a share and was up around 50% and outperforming the market nicely. However, since then, it, took a big dive and has performed horribly. But over the long term, I still believe in PayPal. And if it gets to what I think is fair valuation for the company, it will outperform the market nicely. Anyway, back to the point. Back then, I think it was time to buy some of those growth stocks that were less established. Well, I wouldn't say that Amazon is not established, but it's maybe seen as more speculative. And back then, PayPal, Amazon, Shopify, and SoFi were trading at really nice valuations. Then, toward the end of 2024 and the start of 2025, essentially before Trump got in office, when growth stock valuations were sky high, we had the opportunity to buy more value and dividend stocks because everyone was chasing the returns of growth stocks. Back in January, I fully sold out of my Fubo position after the news about their deal with Disney came out, and I even trimmed a bit of my PayPal position. So sold a couple shares after it ran up 50% to do exactly that, buy value stocks or at least lower valuation stocks. I ended up selling or trimming about 10 to 15% of my portfolio and reallocating that money to lower valuations. And because I already reallocated 10 to 15% of my portfolio, I felt pretty comfortable holding my full Shopify and SoFi positions, even though they were really reaching ridiculous valuations back in January. The reason for continuing to hold is because in the next 3 to 4 years, I believe those companies will be much bigger and stronger, and often it's just best to hold instead of trying to time in and out of those positions. I think there's a very thin line between timing the market and realizing that a company has very little upside over the next 3 to 4 years at a certain valuation. I think it's one of the most difficult things to get perfectly right when investing. That's why I like the approach of staying fully invested no matter what the market is doing, but essentially just trimming those high valuation names and reallocating to lower valuation. And that way, I personally believe we can marginally, little by little, outperform the market over time. And to give you an example of that, just to hopefully help explain it better, back in January, I looked at my Shopify position as it just reached 100% gains in my portfolio. It doubled, right? And I looked at the valuation and thought, holy shit, this is kind of getting ridiculous now. And at that time, Shopify was trading between, 70 to 100 PE ratio. If I hadn't already sold and reallocated 10 to 15% of my portfolio, I may have considered moving some of that money from Shopify to lower valuation stocks like I was buying at the time, which was AMD, Celsius, ASML, and Uber, like I have charted here. And these are other great growth companies that I believe were facing short-term negativity. But if we look at this chart here, so it goes from this, January essentially when my Shopify position was highly valued. In that time, up until now, Shopify underperformed, but 3 out of 4 of those other stocks outperformed. Sadly, though, for me, a lot of that money went into AMD, which is essentially still hasn't worked out for me. AMD is currently my biggest position, and I'm down around 20% on it. However, nothing has changed about the business since I bought it. And if I liked it at, $120 back in January, I really like it here at 90 something dollars. But this is an example of what I mean when I say marginally outperform the market. While I'm not fully selling in and out and trying to time the market, if I were to reallocate from the high valuation Shopify to the lower valuation Celsius and Uber, you know, over time, I think I can marginally outperform. And then when Celsius, Uber, ASML, and AMD have reached those high valuation, I'll essentially do the same with those because I am a strong believer in the fact that there is always a price too high and a price too low for stocks. And sometimes, even though I really believe in the stock in the long term, like I do with Shopify, I think it can be a good decision to take some profits. No matter how good a stock is, they rarely stay at extremely elevated levels for long. But let me say it again, just to make sure everyone gets this point. And this goes back to the overarching idea of dollar cost averaging and always staying invested. And in my opinion, walks that thin line of not timing the market. When I sell because valuations are high, I reallocate that money into other positions. I don't hold cash. Most of the time, I'm not going to catch the absolute top of that stock that I'm selling. And sometimes I may even miss it, and that's okay. But the market can be irrational for long periods of time sometimes. And in my opinion, if I'm holding cash and not reallocating that money, I'm getting closer to the side of timing the market. So back to why it takes time to build out a strong portfolio. It all has to do with market cycles. There will be times to buy growth stocks, but there will also be times to buy those value and dividend stocks. And there will be a time for me to buy those top quality companies in my watch list. Those companies that I see as core, long term, almost hold forever positions. And right now, we're getting close to that time. I personally think a lot of them are trading around fair value right now. However, there are just still some growth stocks that are really undervalued, in my opinion, especially because of all the tariff drama, and I continue to choose those. If I had to put a number on how long it takes to build out a strong, well rounded portfolio, I would say it takes between 2 and 3 years to build out a portfolio that balances those three types really well. And that's because I think it'll take 2 to 3 years to go through all those market cycles and for those opportunities to present themselves. With all that being said, of course, psychology and emotions play into all this. And I never expect to get this perfect with every stock that I own. And we'll always be able to look back and say, well, that wasn't actually such a good move, or, how did I miss this one? On the other side, you can also just choose to not think about market cycles or think about your positions in this way. You can always just hold through any market turbulence and just continue to dollar cost average. But speaking of market turbulence, if you own some of those value stocks and dividend stocks, the value stocks tend to hold up better or lose less during turbulent times. And dividend stocks, assuming you pick the good dividend stocks, will continue to pay dividends during the tough times, so you can use that money to buy growth stocks at super low valuations. And that for me is a big part of how I can get through any type of market. Okay, now for the fourth part of this video, the role of speculative stocks in my portfolio. Speculative stocks actually play an important part in my portfolio. Obviously, with speculative stocks, a lot of the time there's talk of whether or not they will make it, as in, become profitable and self sustaining. So, personally, I'm an investor who's willing to make that sort of bet. However, I don't want to risk my entire portfolio on the success of a company like that. But that's why I try to keep those positions to 1 to 3% of my portfolio, because it doesn't take a lot of money or a lot of positive news for that position to balloon to like 10% of my portfolio. But I'm also very picky with my speculative bets. And throughout the past few years in the market, I've often not even held a speculative stock. But every once in a while, an opportunity comes around that makes sense for me. And in late 2023 and early 2024, that was Fubo TV. The company was still absolutely burning money at the time, but they were slowly getting to profitability. So burning less and less money each quarter as they gained subscribers and got closer to reaching scale. At that time, I was willing to bet that they could make it to profitability and become self sustaining and then grow profits from there before they ran out of cash and went bankrupt. But at the time, they also had a lot of other things going on, like lawsuits, and the other big streaming companies were acting very monopolistic towards them when, it came to pricing and the bundling of content. So there were a lot of big worries. So I was buying the company at around $1.40 to $1.70 and built the position up to about 3% of my portfolio. And that was money I was willing to lose. Then one day, the beauty of speculative stocks played out. Massive news came out before the lawsuit case was concluded about a deal with Disney where Fubo was going to get all this money regardless of the deal going through or not. And essentially, the terms of that deal threw bankruptcy risk out of the window for Fubo. So the stock shot all the way up to like $5.50. I ended up selling all my shares at either $4 or $4.30 ish. The position went from 3% of my portfolio to 10 or 11% just like that in one morning, and that obviously boosted my overall returns a ton. When excitement and big money enters a stock like that, it can balloon so quickly and become a 10% position out of nowhere. And that's why it doesn't need to be a big position in the first place. So that's the part speculative stocks play in my portfolio. That money was then instantly spent buying AMD, Uber, Celsius, and so on. Okay, fifth topic of this video, diversification. Obviously, we all learn very early on that we need to be diversified enough to stay safe in this game. And I think we can all agree on the fact that we should probably hold more than 1 or 2 stocks in our portfolio. However, there's also the risk of over diversification. How many stocks should I own is a question I ask myself for a very long time. At first, I thought that more must be better. However, after learning about the law of diminishing returns, I've changed my mind. If we look at this chart, it shows that as you add more stocks to your portfolio, the volatility becomes lower. However, at a certain point, after adding, the 20th, 21st, or even the 22nd stock, the reduction in volatility becomes so little that it's almost meaningless. And I have a goal of beating the market over the next few decades. And if I choose to hold, 20 to 30 stocks, I may as well be buying the S&P 500 because as volatility drops, so does my chance of outperforming with my stock picks. And what's the point of putting in hours of work researching businesses if it doesn't even make a difference in the end? Therefore, I personally hold just 13 stocks right now, and 4 of those stocks make up 50% of my portfolio. So my research and conviction in these top holdings actually has a chance to make a difference. At the end of the day, this is called personal finance, and you have to figure out what works for you. My portfolio structure and allocations may seem ridiculous to some people, and it may make sense to others. I'm okay with a lot of risk. I'm investing to win and outperform, not to get average returns. And I believe my research and hard work takes a lot of the risk out of the investments. If there's one common thread that wealthy people seem to agree on and talk about, it's taking risk, especially early on. I could probably start over with my portfolio in 10 years from now and end up with average returns, so I have plenty of time left to get average returns. One of my favorite stories and examples of this is Elon Musk. He's not a very popular figure right now, but think about what he's done and the risks he took. PayPal, a company he was the largest shareholder in, was sold to eBay in 2002 for roughly $1.5 billion. His portion of that was roughly $165 million, but I bet taxes ate into that quite a bit. In the following years, he founded SpaceX and invested approximately $100 million into that. In 2004, he became the top investor in one of Tesla's funding rounds, investing around $6.5 million at that point. He later obviously became the CEO of Tesla and invested way more in later funding rounds. Then in 2006, he invested around $10 million in Solar City. Then there are stories from around 2008 where he had to borrow money for rent because he poured every last cent of cash into these investments. Whatever the actual numbers were or whatever the actual dates were may be slightly different, so whatever. But I'm focusing on the overall story of how he invested essentially everything into these very speculative things at the time, took a lot of risk, and now he's obviously the richest man in the world. Then you can debate how risky those investments were. Were they actually risky? And if they were, try to define how risky they were. It's hard. Did his skills, character, hard work, and knowledge of the industries kind of take that risk out of the investments? Maybe. The point is, this whole story may sound crazy to most people, but clearly he was okay with that risk. And that's why this is called personal finance at the end of the day. I don't think there's really any right answer that fits for everyone. Anyway, to end this section, here's what Warren Buffett thinks about diversification.
Yeah, my name is Mark Hake. I'm from Scottsdale, Arizona. And I am very interested in your policies on diversification and also how you concentrate your investments. And I've studied your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable equitable securities portfolio, and there was one year where you only had 3 in 1987. So I have 2 questions. Given the number of stocks that you have in the portfolio now, what does that imply about your view of the market in terms of, is it fairly valued, that kind of idea? And second of all, it seems that whenever you take a new investment, you never take less than about 5% and never more than about 10% of the total portfolio with that new position. And I wanted to see if I'm correct about that.
Yeah, well, on the second point, that really isn't correct. We have positions which you don't even see because we only listed the ones above 600 million in the last report, and obviously those are all smaller positions. Sometimes that's because they're smaller companies and we couldn't get that much money in. Sometimes it's because the prices moved up after we bought them. And sometimes it's because we may be selling the position down even. But so there's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
Do you want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and yeah,
it has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult. And it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
Yeah, we hang around a lot together.
And I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. No. Something very strange is going on.
Yeah. If you find three wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those three. I mean, that's the characteristic of it.
By the way, maybe that's the reason there's so much dementia. If you believe what Warren said, you could teach the whole course in about a week.
Yeah.
Anyway, so this clip kind of just goes back to how I said if you can't or aren't willing to put in the time and effort to stay up to date on your companies and really learn about them and what they're about, you should probably just stick to ETFs. And there's nothing wrong with that. That is the best option for most people, I think. Now, let's move on to the sixth topic of this video. Why pick individual stocks? Why even put in the effort? Well, just 1% can make a huge difference in the long run. So if you beat the S&P 500 by just 1% per year, you could have 30% more money when you retire. And to give you the example, if you invest $500 per month over 40 years, earning an average 10% return per year, you would end up with $2,655,000. However, if we manage to outperform the market by just 1% each year, so earning an 11% return, we would end up with $3,490,000 after those 40 years. That's 30% more money. And that's why I put in the hours of work to research stocks. Because what if we outperform by 2%? Change this to 12, that's 4.6 million. What if we outperform by 5%? Then we're, in the territory of being good investors. That moves up from 2.6 million to 10.6 million. What if we do great and amazing investors outperform by 10%? That bumps up to 44 million. I mean, just look at how dramatically the end result changes. And I would encourage you to play around with this with your specific numbers. It's investor.gov. Just look up compound interest calculator, and it should be one of the first options. So here's what my numbers look like if I put in the exact numbers that I've been dealing with recently. So I have around a $79,000 portfolio to start with. I'm investing 500 weekly. If I get that 10% average return over 40 years, that will be $14,200,000. And let's change it. Let's say I outperform, pick some good stocks over the next couple of decades, outperform by 1%. That 14 million turns into 19 million. Let's say I outperform by 3%. Then all of a sudden, that's 34 million. So it makes a big difference. Say I outperform by 6%. That's 86 million. 20%. It's going to be incredibly difficult, but $292 million. So that's why I put in the effort to learn more about this and research the stocks and try to really stay up to date on everything surrounding them. But that'll be it for this video. Let me know in the comments what you think about my strategy and if you think there's anything I can improve on. I'm always looking to learn and get better. See you in the next one.